Welcome back to the Wall Street Podcast. Today, we're taking a deep dive into the latest research report from Goldman Sachs, specifically their APAC Conviction List Director's Cut August, which came out August 3rd, 2025. Our mission, as always, is to quickly distill the crucial shifts in their Asia-Pacific conviction list. We'll highlight, the new additions, the removals, and the key market strategies for the region.
That's right. And the report flags two significant additions to the list, Jardine Matheson and Nomura Shipbuilding. At the same time, it notes the removal of Mahindra, Kotobuki Spirits, and Worley.
Okay, let's unpack Jardine Matheson first. What's the core thinking there?
Well, Goldman's conviction, according to analyst Simon Chung, it really hinges on the group's renewed focus. Things like high-caliber leadership, operational improvements, efficiency gains. They believe this focus could drive a re-rating, maybe through group restructuring, perhaps asset divestment, or better shareholder returns.
And the valuation reflects that potential.
It seems so. The stock's trading at a pretty notable 38% discount to NAV and an 8.8 times FY26 estimated PE with a 4.3% dividend yield. That's actually below its historical averages.
So what's the catalyst then?
It looks like the strategic review's underway at key subsidiaries. Think HK-Land, Dairy Farm, JC&C, Astra. Those are expected to wrap up by the first half of 2026. Plus, the incoming CEO, Lincoln Pan, who starts in December 2025, is expected to accelerate these reviews and maybe push forward on investment or divestment decisions.
Okay, so that's Jardine. Now, Nomura Shipbuilding sounds like a very different story.
It is a really compelling thesis here. Analyst Norihiro Miyazaki argues the market is, frankly, underappreciating Nomura's outlook for sustainable revenue and margin improvement. His forecast: an 11% operating profit CAGR from fiscal year March 25 right through March 2030 estimate.
11% CAGR. What's driving that confidence?
A couple of key things. First, the expectation that Japanese shipbuilders will grab more market share. This is tied to rising geopolitical risks. Specifically, recent U.S. government announcements about hiking port facility fees on ships built in China. That directly helps the cost competitiveness of Japanese builders like Nomura.
Geopolitics playing a direct role.
Exactly. And second, there's strong potential for growth in defense-related maintenance work. This is fueled by, increasing demand from the U.S. Navy to cooperate more closely with treaty allies.
Interesting. Okay, so Module 1 thinking. With these global economic shifts, tariff impacts, geopolitical factors, how might the average consumer start feeling the effects?
Well, the report does see the U.S. GDP growing, but moderately. It anticipates 3 Fed rate cuts starting in September. And while China's real GDP growth was better than expected in the first half of 25, the report calls the consumer backdrop there unexciting. It points to pricing downside risks, suggesting pressure on retail prices, maybe on discretionary spending for everyday goods. And that shift in shipbuilding market share, driven by tariffs, that could subtly influence global supply chains' trade costs, eventually hitting the price of imported goods for consumers.
Right. Okay, Module 2 then. Industry shifts. You mentioned technology, healthcare, defense earlier. How do these high-level shifts translate into, tangible changes for us?
Good question. The report points to robust growth in AI applications in tech. That suggests, more efficient services, maybe smarter devices in our daily lives. In healthcare, look at China's booming out-licensing trend companies like Zai Lab. This points to faster development, potentially better access to new, innovative treatments. And the defense demand in shipbuilding, like with Nomura, that just reflects these broader geopolitical trends influencing national investment, infrastructure priorities.
Makes sense. So Module 3, corporate strategy. Connecting this back to Jardine Matheson's reviews, what does this broader focus on restructuring and capital allocation mean for investment opportunities for overall market health?
It signals a pretty significant corporate trend. Companies are trying to unlock value, enhance shareholder returns. Like Jardine, this often leads to more focused businesses. It can spark M&A activity, maybe improve dividends for investors. You might also see shifts in regional employment as capital gets moved to higher growth areas. Ultimately, it's a strategic drive for optimized performance in what's a very competitive global market. Good for investors who spot these catalysts early.
So let's bring this home. For our listeners, how might these quite high-level financial movements actually show up in daily life?
Okay, well, the efficiency drive by big conglomerates, that could mean more streamlined services, maybe different product offerings from their subsidiaries you interact with. Those geopolitical shifts affecting manufacturing, like shipbuilding, over time, that could change the cost and availability of goods shipped globally, so the price of things you buy. And the constant focus on tech, like AI. That implies innovation keeps accelerating, bringing new products, new services into our lives faster. While those consumer trends mentioned, especially out of China, give clues about overall economic confidence, which affects household spending and saving everywhere.
So, as you consider these dynamics, the question to ask yourself is, how will these deep-seated shifts in global capital allocation and corporate strategy reshape the economic landscape and maybe your own investment decisions in the coming years?